Hi, I'm Staci from FundCaliber, and today we're looking at what's stopping people from investing in sustainable options. Well, according to a survey we did amongst our users, it's the confusing terminology that's holding them back. So in this video, I'm going to explain some of that terminology in a hope that it will encourage you, yes, you, to invest more sustainably. Let's start with ESG. You'll hear and see that a lot. It stands for environmental, social, and governance issues. Environmental is pretty straightforward. It's things that companies do that are good or bad for the environment. Social is how a company manages its relationship with its employees, suppliers, customers, and the communities in which it operates. So does it treat them well or badly? Governance is all about how the company makes decisions, how its directors are paid, the makeup of its board, etc. Broadly speaking, there are 3 ways to incorporate ESG factors into an investment process. We're going to look at those 3 in turn. The first is by screening for certain factors. This is the oldest and best known form of ethical investing. Negative for screening refers to avoidance of certain things like companies involved in animal testing, gambling, nuclear power, alcohol, and tobacco. Sometimes these types of companies are referred to as sin stocks. Positive screening is the opposite. It's when you're looking for certain good qualities in a company, like are they reducing their carbon emissions or have a gender equality on the board of their directors. Then there's integration. Integration means that ESG factors are considered in the decision-making process and the investment analysis. It's not about simply screening, but being aware of their sustainable characteristics. All of our elite-rated ethical funds have a degree of integration in their process. It's what makes them sustainable investments. Lastly, there are thematic funds that invest in something specific, like decarbonization, clean energy, or water. Thematic funds also incorporate impact investing. This impact is measurable. An investor or fund manager will measure and report on the social and environmental performance of the companies in which they invest. Now, this is easier said than done in many cases, with no formal requirement for companies to release complete data in a consistent format across geographies. Investors' approaches will differ in this aspect. Many funds use a mixture of these approaches, and more generalist or mainstream funds are also incorporating some of these elements in their investment processes. As a result, stewardship or engagement, as it's sometimes called, has become increasingly popular and a large part of fund management. Stewardship refers to the extent to which managers engage with the companies they invest in to drive change. Managers can discuss ESG issues with the company's help, develop more sustainable business practice. Engagement also includes proxy voting. This is where a fund manager formally expresses approval or disapproval through voting on resolutions and proposing shareholder resolutions on specific ESG issues. These terms will often be found in the introduction and investment process section of a fund. However, when you're researching a fund, you could find a whole range of other terms from SRI to UN SDGs. So to discover what all of these mean, watch our next video, and don't forget to like and subscribe for more weekly videos. You can also visit fundcaliber.com to start your research today and discover all of our sustainable elite-rated funds.